Hello and welcome to my channel, where I talk about the latest news and trends in the world of economics and finance. Today, I'm going to discuss a very interesting topic. Is China suffering deflation? Deflation is a situation where the overall price level of goods and services in an economy falls over some time. This means that your money can buy more things than before, which sounds like a good thing, right? Well, not exactly. Deflation can have many negative consequences for an economy, such as lower consumer spending, lower business investment, lower profits, lower wages, higher unemployment, and higher debt burdens. Deflation can also create a vicious cycle where people expect prices to fall further in the future, so they postpone their purchases, which leads to lower demand, which leads to lower production, which leads to lower prices, and so on. So why are we talking about deflation in China? China is the second largest economy in the world and one of the fastest growing ones. China has been a major driver of global growth and trade for decades, and its economic performance has had a significant impact on the rest of the world. China has also been known for its high inflation rates in the past, especially due to its rapid industrialization and urbanization. However, in recent months, China has shown signs of slowing down and cooling off. And one of the most striking indicators of this is its Consumer Price Index, CPI, which measures the changes in the prices of a basket of goods and services that are typically purchased by households. According to the official data released by the National Bureau of Statistics of China on Wednesday, August 9, 2023, China's CPI fell by 0.3% year-on-year in July 2023, after being flat in June 2023. This means that the average prices of goods and services in China were lower in July 2023 than they were in July 2022. This is the first time that China has experienced negative inflation or deflation since early 2021 when the COVID-19 pandemic hit the country hard and disrupted its supply chains and demand patterns. What are the main factors behind China's deflation? There are two main categories of factors that affect inflation: demand-side factors and supply-side factors. Demand-side factors are related to the level and composition of spending by consumers, businesses, and governments in an economy. Supply-side factors are related to the availability and cost of inputs and outputs in an economy. On the demand side, China's deflation reflects a weakening of domestic consumption and investment. China's retail sales growth slowed down to 8.5% year-on-year in July 20,235, compared to 12.1% in June 2023. This indicates that Chinese consumers are spending less on goods and services than before, partly due to the uncertainty caused by the COVID-19 variants and the sporadic outbreaks that have led to lockdowns and travel restrictions in some regions. China's fixed asset investment growth also decelerated to 10.3% year-on-year in July 2023, compared to 12.6% in June 2023. This indicates that Chinese businesses are investing less in infrastructure, machinery, equipment, and buildings than before, partly due to the tighter credit conditions imposed by the authorities to curb financial risks and debt levels. On the supply side, China's deflation reflects a decline in the prices of some key commodities and products that have a large weight in the CPI basket. The most notable one is pork, which accounts for about 2.8% of the CPI basket. Pork prices plunged by 26% year-on-year in July 2023, after rising sharply in 2019 and 2020 due to the African swine fever outbreak that decimated China's population. The recovery of pork production and imports has led to an oversupply of pork in the market, which has driven down its price. Another important factor is transportation, which accounts for about 10% of the CPI basket. Transportation prices have dropped by 4.7% year-on-year in July 2023, mainly due to the lower cost of fuel and vehicles. Global oil prices have fallen from their peak levels earlier this year due to the weaker demand outlook amid the COVID-19 resurgence. Vehicle prices have also fallen due to the intense competition among car makers, especially after Tesla cut its prices in China earlier this year. What are the implications of China's deflation for its economy and policy? China's deflation poses a challenge to its economic growth and stability. As mentioned earlier, deflation can reduce consumer spending and business investment, which are essential for sustaining economic activity and creating jobs. Deflation can also increase the actual value of debt for households, firms, and governments, which can make it harder for them to repay their obligations and increase the risk of defaults and financial crises. Deflation can also erode the competitiveness of China's exports, as its goods and services become relatively more expensive in foreign markets compared to those of other countries that have higher inflation rates. China's deflation also complicates its monetary policy and exchange rate policy. China's central bank, the People's Bank of China, PBOC, has a dual mandate of maintaining price stability and supporting economic growth. However, these two objectives may conflict with each other in a deflationary environment. On the one hand, the PBOC may want to ease its monetary policy by cutting interest rates and injecting liquidity into the banking system to stimulate demand and push up prices. On the other hand, the PBOC may want to tighten its monetary policy by raising interest rates and draining liquidity from the banking system to prevent capital outflows and defend the value of its currency, the renminbi, RMB. The RMB is not fully convertible, but it is linked to a basket of currencies, mainly the US dollar, through a managed floating exchange rate regime. The PBOC intervenes in the foreign exchange market to keep the RMB within a specific range against the basket. However, if the PBOC lowers its interest rates too much, it may create a negative interest rate differential with other countries, which may encourage investors to sell their RMB assets and buy foreign investments, putting downward pressure on the RMB. This may force the PBOC to sell its foreign exchange reserves and buy RMB to support its exchange rate, which may reduce its monetary policy autonomy and effectiveness. How can China escape from deflation? China needs to adopt a comprehensive and coordinated strategy to overcome its deflationary pressures and restore its economic momentum. This strategy should include both demand-side measures and supply-side measures, as well as fiscal policy and structural reforms. On the demand side, China needs to boost its domestic consumption and investment by increasing its fiscal stimulus and improving its social safety net. China's fiscal deficit widened to 3.7% of GDP in 2020, as it ramped up its spending on public health, infrastructure, and social welfare to cope with the COVID-19 shock. However, China's fiscal deficit is expected to narrow to 3.2% of GDP in 2021, as it plans to reduce its fiscal support and consolidate its public finances. This may be premature and counterproductive given the ongoing weakness in demand and deflation in prices. China should maintain or increase its fiscal stimulus, especially by expanding its social spending on healthcare, education, pensions, unemployment benefits, and poverty alleviation. This will not only help cushion the impact of the pandemic on vulnerable groups, but also increase their disposable income and consumption confidence. China should also invest more in green and digital infrastructure, such as renewable energy, electric vehicles, 5G networks, artificial intelligence, and cloud computing. This would not only enhance its productivity and competitiveness in the long run, but also create more jobs and demand in the short run. On the supply side, China needs to stabilize and diversify its sources of inputs and outputs by strengthening its domestic production capacity and expanding its external trade relations. China has faced various supply shocks in recent years, such as the trade war with the US, the COVID-19 pandemic, the chip shortage, and environmental regulations. These shocks have disrupted China's supply chains and increased its production costs. China should improve its self-reliance and resilience by investing more in research and development, R&D, innovation, and industrial upgrading. This would help China reduce its dependence on foreign technologies and materials, especially in strategic sectors such as semiconductors, biotechnology, aerospace, and defense. China should also diversify its export markets and import sources by pursuing more free trade agreements, FTAs, with other countries and regions. This would help China access new opportunities for growth and cooperation, as well as mitigate the risks of protectionism and isolationism. To sum up, China is facing a deflationary situation, where its consumer prices are falling year on year for the first time since early 2021. This is mainly due to the weakening of domestic demand and the decline of some key commodity and product prices. China's deflation poses a threat to its economic performance and policy management, as it can reduce spending, investment, profits, wages, employment, and competitiveness, as well as increasing debt burdens and capital outflows. China needs to adopt a comprehensive and coordinated strategy to overcome its deflationary pressures and restore its economic momentum. This strategy should include both demand-side measures and supply-side measures, as well as fiscal policy and structural reforms. That's all for today's video. I hope you enjoyed it and learned something new. If you did, please give this video a thumbs up, share it with your friends, and subscribe to my channel for more videos like this. Also, don't forget to leave a comment below and let me know what you think about China's deflation and how it can deal with it. Thank you for watching, and see you next time.